Good afternoon, everyone. I guess in the interest of time, potentially, and to give you a bit more time for the discussion afterwards, I'll try to keep my intervention fairly brief. I mean, by now I assume everybody in the room is fairly familiar with the proposal of the Commission. I'll just do a quick recap, if you want, of the banking package that was adopted last November. So you've already discussed the resolution bit, so I'm not going to touch upon that. I'm going to just touch upon the, if you want, the prudential side of the package. So it can be resumed basically in two broad groups of measures. The first group is, of course, the adoption of the so far agreed Basel standards at international level, so NSFR, leverage ratio, the fundamental review of the trading book, the new large exposures regime, the standardized approach for counterparty credit risk, and the new disclosure rules. And the second part is more, if you want, supervision, EU specificities oriented, is clarifying the rules on Pillar 2, clarifying the interactions between the different types of requirements, the so-called stacking order of the capital requirements. It's about, as Mr. Karas mentioned earlier, exposures to small and medium enterprises, also a new treatment for investment in infrastructure, and of course the now, I don't know if I should call it famous or infamous, proposal to have an EU intermediate parent undertaking for third country banking groups. The overall objective of the package on the prudential side can be split sort of like in two parts. One is ensuring a stable banking sector so that our banks are properly capitalized and have sufficient amounts of liquidity to deal with their liquidity needs. But on the other hand, also ensure that the banks which our economies heavily rely on for financing keep financing the economy. To this end, I've already mentioned certain measures that we did. So the SME supporting factor, the extension for exposures above €1.5 million, specific treatment for this, if you want, a specific beneficial treatment for investment in infrastructure. And then we have certain specificities in terms of the implementation of the international rules. Specifically under the leverage ratio, we have the exemption of exposures of promotional banks, which I would underline is not a deviation from Basel, because promotional banks are, to begin with, not in the scope of the Basel framework anyway, because they're not large internationally active, well, they're not internationally active banks, I should say. Then we have the possibility for banks to actually take into account initial margin posted by their clients in the central clearing context. So they basically are allowed to reduce the exposures by the initial margin. That adjustment was introduced in order not to create issues in the central clearing framework, because we had observed that in the market a lot of clearing members were starting to either reducing the amount of client clearing services they were offering to their clients, or altogether abandoning the activity, which of course posed a potential threat to the clearing obligation that we have under EMIR. Then Mr. Karas already mentioned some of the other adjustments that we made to the various issues. One was on the fundamental review of the trading book, where we have a 3-year period where we actually adjust the calibration of the capital requirements for the trading book, so for market risk. There we already know that there are specific issues with the international standards that are currently under review. It's about calibration of standardized approach versus the advanced approach. It's about the P&L attribution and so on and so forth. So we kind of thought that to stay on the sort of kind of a better safe than sorry attitude, we decided basically to adjust the initial impact of the fundamental review of the trading book, give ourselves 3 additional years to actually analyze the impact, take into account whatever changes were coming from Basel, and then move forward with potential adjustment to the framework and then the full implementation of it. And last but not least, on the NSFR, there are adjustments there as well, specifically on the treatment of derivatives, where you have, again, similar to the FRTB, a transitional period, because we know that in Basel, basically the treatment is being reviewed, or at least looked at for the time being. And there are also certain specific adjustments to take into account European specificities like the treatment of covered bonds and the treatment of, so it's the fully, interlinked assets and liabilities. Sorry, the exact term actually escapes me right now. But to cut a long story short, we have by and large implemented basically what was agreed at international level, with taking into account certain specificities, giving ourselves an additional amount of time to basically fully gauge the impact of the measures that are to be introduced. We've also tried to, as much as possible, clarify existing rules on the supervisory side, so that basically we provide some sort of predictability and clarity for banks in terms of supervisory action. As you've heard, and as you probably already know, part of the rules have been fast-tracked, specifically the IFRS 9 transitional provisions and some transitional provisions dealing with specific large exposure limits for some sovereign exposures. Negotiations are ongoing, and from the Commission perspective, we hope that they will be concluded as quickly as possible so that essentially industry gets the regulatory certainty it needs so that they can actually get on with their business, which is lending money to the economy. Thank you.